What's going on today, YouTube? Today, I had a different video planned, but since the stock market is crashing right now, I figured this would be more appropriate. So I'm going to tell you 5 things before making a rash decision. So if you like these tips, I make content like this daily. Give the video a like, subscribe to my channel, share it. Let's get the word out there, guys. So at the end of this video, you better have a good idea if you're going to stay in or adjust your portfolio a little bit. So here we go. Number 1, this happens all the time. Sorry to break it to you guys, but it does happen. This is chart since 1993 or 92. S&P 500. So we're going to use this as an example. And I mean, it's been a bull market for the past pretty much 10 years. So now everyone's freaking out because they act like this has never happened before. So what I want you guys to look at. Right now, we are in about total a 5-6% drop in the past, all of last week and today. And I'm filming this on February 5th. So I just want you guys look real quick. Look back in 2015. Look at that drop, 12%, and it rebounded. We'll look back here. After the bear market started the bull market. About an 18% drop. These aren't exact, but you get the idea. Back here, 12% drop. And like I said, we're at about a 6% drop right now. So right now, this could be a fake. Could be a fake out. Don't know. It could be the real thing. So, this leads us into tip number 2. If you are planning on staying in the market for the next 10 years, and I'll show you why I'm going to say 10 years, I do not think you have anything to worry about. Over the time period, you got to look at the past. You got to look at the past, and the past tells you everything. Past repeats itself. Look at this. We're going to just average this out. 1999 to 2000. That's when this first bear market started. And it took, we're just going to say 1, 2, 3, 4, 5, 6, 7, 8 years to get back to its all-time highs of that, like this time period. These were at all-time highs. It hit again all-time highs and crashed. But that took 8 years. Falling and coming back up. Okay, second one. We're going to say 2007. We're going to say 1, 2, 3, 4, 5, 6, 7 years. So this is why I'm saying if you're going to be in for the next 10 years, I don't think you have anything to worry about because it's going to come back to where it is. If you're out sooner than that, honestly, you should have been more diversified before and you should have had more in bonds. The closer you get to retirement or whenever you're going to decide to live off the money that you've made, you need to go into safer investments. This would be bonds. They're lower returns, but they protect your money a lot more. So, we're going to go into the third point. Number 3. I like looking at this EMA line, this blue line. I extended it to 25 for this video just to get a more broad case. And the larger that number is, the longer it takes it to fluctuate. If you make it smaller, it'll go up and down a lot more rapid. And I wanted it to go below the candles rather than through. So, as you can see, when anything rises, it stays along above that EMA line. And then when it starts flattening out, as you can see up here, I'll zoom in a little bit. When it starts flattening out, that's a sign of reversal, okay? See, even down here, it was falling until it flattened out, so the pattern reversed, went back up. Right here, flattened, reversed, flatten, reverse. Okay, I'm sure you guys get that now. So if you look right now, we are still trending above this line. Well, right here, that was a little fake out, like I said. That's when we lost around 12, 13%. So right now, we are still trending above that EMA line. Until this crosses over and starts trending below and bouncing off and hitting lowers, what I mean by that is how this crossed below and then couldn't get above. It kept on hitting it and falling back down and falling back down and falling back down. That's what happens. Then when it trends above, it does the same thing, hits and goes back up. So me, personally, I would not be scared that this is the start of a bear market until we cross below this line well, first of all, it flattens out. It's still pointing up. If you look, it's still pointing up. So first off, flattens out, and we start trending below the line, like in these cases scenarios, flattened out and trending below the line. That would confirm to me that we are in a bear market. Right now, that is no confirmation. It's just, it could be just another correction, and don't be surprised if it falls another 6%. All these other fake outs, they call them, fell about 12 to 20%. So this could be a fake out. Pulling into number 4, if you are a person, even though regardless you're planning on being in the market for another 10 years, if you are the person that is just devastated and can't stand seeing their money go down, the only thing I can recommend, readjusting your portfolio to put more in bonds and less in stocks. But even though you're doing this, I still would not, if you are a person that invest the same amount every month, I would say you still put at least 25% into the stock market, and then you put the 75% into the bonds. Because as you're investing, as it falls, you get it at a lower price. So you're going to keep on getting it at a lower, like say this happens. So you're going to keep on getting it lower and lower and lower and lower and lower. And this is just for indexes. I'm not talking about regular stocks. You don't, like indexes, they bounce back. I'm not talking about individual stocks. So you want to look at the Vanguard Total Index because it replicates the stock market, you can see, but it's a lot cheaper price. It hasn't been around as long as the S&P, so I'm going to go back to the S&P. Back to the S&P. So if you really can't stand seeing your money go down that rapidly, readjust your portfolio and make it so you're still at least putting in 25% of your monthly amount into the stock market, and then 75% goes into bonds. It's much safer, but you're not going to get the same gains. It's a way of holding your money, making little gains rather than the major gains that we're used to in the past 10 years. And my last, number 5, my last case in point, in these past bear markets, these two, if you look, they lost about 50%. 50%. I told you I'm a technical trader too. I thought this was kind of interesting. If I draw a line here, which is going to be our new support line, if I draw a line here, because this is where the market was trending back before it broke between these two. If we went from here down to here, I know it's hard to see, but that top percentage you can see up there, that is about a 45% loss. Here, 49% loss. There is a little resistance here, but if the past repeats itself, don't count out it going the whole way back down to here before it starts turning into a bull market again. And like I said, we need to get that confirmation of this thing trending below the EMA line and keep on bouncing off and going lower. Right now, it still has not crossed below this EMA line. This EMA line is not flattening. So right now it's a fake out, in my opinion. I hope this cleared some stuff up for you guys. If you liked the video, give it a like, share, subscribe. I upload daily, and I'll see you guys tomorrow.